Welcome, everyone. My name is Brett Sebion, part of the Emerge 360 team at TrustPoint. Welcome to the Q3 2023 Market and Economic Overview. As a reminder, your portfolios are managed by the TrustPoint investment team, and you'll see the TrustPoint logo throughout the presentation. A lot to unpack today, so let's get started. Really, the past 12 to 18 months have been a very challenging environment for investors, whether we're talking about global stocks or global bonds. From January of 2022 through early October of 2023, broad fixed income markets were down over 8%, and broad stock market indexes were down about 6%. Now, 2022 was a lot worse than what we've experienced in 2023, and we'll cover that. But long story short, it's been a challenging environment, and we remain defensive within our client portfolios. We continue to be positioned for a recessionary environment where it's a challenging environment for risk assets like the stock market. And we'll cover at the end kind of what our positioning is. But really want to cover today what has led us to that positioning and why we remain defensive within client portfolios. First, just want to talk about returns for a little bit. So year to date, global stocks are up about 11%. Over the 1 year, they're up about 22%. So it really has been a strong rebound. But with that being said, it's been very narrowly led. And what I mean by that is that a small number of stocks have generated very, very positive returns, while the rest of the market really hasn't experienced that. So the one that jumps out of the page in the year to date column is US large cap growth. So think about large cap technology stocks, specifically those stocks that have kind of been involved in the artificial intelligence or AI discussions and craze that has been going on in 2023. You can see amongst other asset classes, there's still been positive returns year to date out of the market, but it's really been led by a small number of stocks. And that's what this chart shows here. So this is called the Elite 8 is what we call these 8 stocks that have had very good performance. They're all listed in the bottom left-hand corner. So we have Facebook, Amazon, Netflix, Microsoft, Apple, Google, Tesla, and NVIDIA. When you combine all of their performances from basically 2022 or the start of 2023 through early October, they're up about 84%. The S&P 500 index, which is a US large cap index, is up about 16%, but the remaining 492 stocks out of the 500, ignoring the Elite 8, is barely positive. So it's very, very telling that a small number of stocks have really done the heavy lifting for markets in 2023. Fixed income returns. So year to date, global bonds are up about 1%, but US bonds are down about 1.2%. And over the 1 year, we have global bonds up about 2% and US bonds up about 6%. So remember, in 2022, not only was the stock market down, but the bond market was also down, which is something investors have never really experienced for a long, long time. So as interest rates rose, bond prices fell. So investors experience that negative return when historically, when markets are down 15, 20%, the fixed income part of client portfolios tends to hold its value. But 2022 was very, very unique. Now, fast forward to today, there's been quite a bit of opportunity that has came from interest rates adjusting higher. Investors are able to lock in those higher interest rates. And if those interest rates were to fall, you're also going to get bond price appreciation. So that's an environment that we think will come. The catalyst may be an economic recession. And that's part of the positioning within your portfolios, being overweight fixed income to benefit from that type of environment. So moving on to the recession talk. So as I said in the beginning, we have positioned client portfolios for a recessionary environment where risk assets have a challenging environment. We've said all along that this recession is a Fed-induced recession by a tightening cycle. This isn't going to be a financial crisis like we had in 08, 09. It's not going to come from terrible excess in the economy like the dot-com bubble in the late 1990s. This is a recession that is driven by the Federal Reserve increasing interest rates. So with that framework in mind, whether it's going to be a soft or a hard landing has been part of the argument. So Trust Point falls in the hard landing camp, but I kind of want to go through this framework and then show some supporting data why we believe this is going to happen. So whether we're talking about a soft landing or a hard landing, it all starts with the Federal Reserve increasing interest rates. Recipe for a hard landing: high sticky inflation and also tighter lending standards. Recipe for soft landing would be low inflation and easy lending standards. So a couple different things I want to discuss. Soft landing, definite possible scenario, but in our opinion, unlikely. So when we look at Federal Reserve tightening cycles going all the way back to the mid 1950s, 10 out of the 13 ended in a recession. So yes, it's possible that a soft landing happens, but looking back at history, we know that tightening cycles often lead to a recession. 10 out of the 13 going back to the 1950s. Also, we'll note that the times we did enter a recession, these 10 times, inflation remained sticky, which is definitely an environment that we continue to be in today. Monetary tightening cycles. So we've gotten a few questions. You've positioned for a recession. You've had a recession call. Why hasn't it came yet? Well, when interest rates rise, when the Federal Reserve increases interest rates, that takes a long time to filter through the economy. And that's what this example is showing. So this goes back to all of the Federal Reserve hiking cycles all the way back to the early 70s. So we have the first Fed rate hike listed out here. And the average months for the tightening cycles that led to a recession after the first interest rate hike was 31 months. Okay, so the recent tightening cycle that started in March of 2022, let's say that we are in March of 2024, right? That's 24 months. That's still under the average of the time we see by the time the Fed hikes for the first time and the recession hits the economy. So just, want to reiterate that we still have our recession call, but increasing interest rates takes a long time to filter through the economy and the impact that they do have. Some other supporting charts here. Every time inflation has been over 5%, we've had a recession. So you can see that inflation hit the highest it has seen in over 40 years. It's came back down, right? But it still remains kind of above the Federal Reserve's target of 2%. Banks are tightening their lending standards, which traditionally has led to a recession. So this orange line here is the bank's willingness to make consumer loans. So you can see that it has, kind of collapsed to levels, similar to COVID, financial crisis, and other recessions that we've seen. So we've had high sticky inflation. Inflation, hit well over 5% at its peak, and banks' willingness to make consumer loans continues to go down. So with all that in mind, we continue to be underweight equities and overweight fixed income within client portfolios. So for example, if you are in a balanced strategy, our target would be 50% stocks, but right now it is 43% stocks and 57% fixed income. So again, we've done a lot to get to this positioning over the last 12 to 18 months. And I know we usually follow up on the recent portfolio changes. We haven't made one since June, but when we talk about the ratio between stocks or bonds, we haven't made a change since February of 2023. That was our last trade that got us to the underweight equities to where we're currently today. In April, we made a trade that became more defensive within equities. So we cut our exposure to the more cyclical and sensitive areas of the market. And in June of 2023, we became more defensive within fixed income. So this increased our exposure to longer term treasuries and decreased our exposure to shorter term treasuries. So if we were to make any more trades or to get any more defensive, it would come from the fixed income side of portfolios, where we would do something similar to what we did in June of 2023. But we feel comfortable about our positioning. If if and when an economic recession does come, we feel like our positioning is well set. So just want to take a minute to thank everybody. Know it's been a very challenging environment when it comes to the investment journey, but would encourage people to still kind of have that long-term mindset intact. We feel that we have positioned portfolios accordingly for what we believe will be a challenging environment, and we just appreciate everybody's patience and trust over the last 12 to 18 months and in the future. So as always, feel free to reach out with any questions. Hope everyone found this helpful, but happy to elaborate on anything more offline. Thanks, everyone.